All right, everybody. Here we go. 15 seconds to closing time. And 5, 4, 3, 2, 1. All right, look at that. Right on the nose at 28. How about that? Hello, everybody. Can you hear me okay? I'm supposed to get comments here. Do I show comments? Live viewer comments show up on screen. Does this work? Tom's here. All right, there we go. There it is. All right, all right. Rihards Grislis. That almost sounds like a Lithuanian name. Good stuff. All right, people coming in. There is sound. Indeed, Eve, there is sound. Nimon's in here. How do I get this? What is this? Latvian. All right. I was in Latvia not too long ago, actually. For the first time last year. I was in Latvia for a wedding not far from Riga. Very good. Very good. Yeah, everybody, welcome to the end of another trading week. By request, I thought it was like the idea of trying out a live stream format on weekends, right after getting all closed up with my breakdowns during the week. I thought this could be a good opportunity maybe for some Q&A, something a bit more interactive rather than pre-structured. So yeah, I figured we could start out with a little bit of reflection on our situation here. Oh yeah, nice. I can do this nice and big. This is one of my first times doing streaming through my particular recording platform that I use here. I use StreamYard. Well, this is pretty cool. Yeah. So, okay, for those of you who took a look at the article earlier today, who took a look at my video, yeah, we ended up having a close basically right at max pain. The official close $27.99, so 1 cent below max pain. We're a little bit above it now, ticking up to 2805, 2809. I'm not sure how long that's actually going to last. But yeah, so all of those options contracts, all of those calls, all those 20 some odd thousand calls at $30 out of the money, absolutely worthless. All of those calls, those 6,000 calls at $29, worthless. All of the calls at $28.50, $28 now, right? I mean, the ones at $28 are worth a couple pennies currently, but we're not sure how long that'll last. So yeah, certainly if you're a newer person joining us here, yeah, I know Tom is what a surprise. Yeah, so this is kind of what we were thinking. This is what I was thinking earlier in the week, definitely around earnings. We broke to the upside in terms of bullishness, right? So if we go to our 5-year chart or 5-day chart, I should say, yeah, we definitely broke to the upside. But that test we had of $30, seen this play out a lot. We trade down, and we had to max pain. I think certainly early today. I think I started to point this out on my video today. Yeah, a lot of shorting probably going on through here, especially this candle. What was this, around 100,000 shares? Yeah, I think there was really just too much potential gamma exposure for market makers to risk not allowing this to not allowing these calls to all close out of the money, especially appetizing given that we had a $28 close. Yeah, we had this moment right early on when we touched the $28 gamma position here. When we dip below there, we can see we dipped into intraday overbought territory or oversold territory on the RSI and got this pretty cool reversal. I was very tempted to trade this. I decided not to. I'm not a super active trader. That's not. I've tried different really active strategies in the past before. Definitely, it's a lot. I would say active trading is a lot trickier than it looks. So if you got to have a really kind of rigorous method. You have to have a pretty sound meta game built around your trading, built around these different scenarios in order to optimize and forward project profitability. If you're going to be sort of a frequent day trader, it's very difficult, especially if you're going to be an options day trader. Takes a lot of focus, takes a lot of trial and error, takes a lot of discipline. So was very tempted here, right? A past trading me would have may have taken this trade, but there was potential that we were going to see some gamma action, some heavy bullish flow kind of pick up, but yeah, just kind of shy of this. Really on the way, we didn't get too far into the approach to this $29 gamma position. Just momentum kind of ran out. We were never super bullish on the day, options flow wise, and just worked our way back down to max pain and this $28 gamma position. So, overall, this is great. Let me see if I can clean up some of my studies here. Let's just go. Oh, no. I want to do drawing set. Yeah, there we go. That's a little better. Right. So like we talked about earlier, great sign here. That's a close basically right on top of our 200-week moving average. In fact, we move right below it, but right now, after hours, we are basically right on top of it by a few cents. So this is good, right? This is basically, technically speaking, this is our third consecutive week on top of, closing basically on top of our 200-week moving average. The last time that we did that, well, we did have this kind of period here around earnings, very different context in 2022. We traded up above this. Very different sort of setup with our moving averages here. We had 1, 2, 3, 4, 5, 6, 7, 8, 9, just about 9 weeks up here. But that was on a downtrend. The last time we were in this configuration, basically in a bullish movement up, basically trending up and approaching this limit, right? Moving above this limit was, right before, if we take a look, right before we had this January price action. So 1, 2, 3, 4, 5, 6, 7 total weeks we traded up above our 200-week moving average on the approach to 2021. So maybe we're looking at something similar this year. Certainly, if we're just looking from something like a historical perspective, that's a good sign. We'll have to see what that looks like. Moving forward. If we bring our drawing set back up here with our regression levels, finishing more or less within, still in this kind of overlap zone between these regression channels. I think probably, like, at least what it looks like so far, barring some kind of major catalyst again, there was a possibility that gamma ramp could have been run pretty heavily if we got something like a big catalyst. We did not. Doesn't mean that there won't be one maybe coming in a week or 2 weeks or something like that. We get some news from the company. But yeah, it really looks like this bearish channel is kind of flattening out. So it might be that we kind of go sideways, that we attempt to move into a range bound situation like we did here, right? So, we rounded out this downward trend until it became pretty flat, right? Consistent lows, no new lows. That is something that we're starting to see here, right? We're starting to look at a series of higher lows. The lowest we really got was on this earnings after hours candle here. So if we can get something like that, right, where we just kind of flatten out here, lower highs but lower lows, then I think, yeah, somewhere here we could see this regression channel kind of flatten out, and then maybe after December OPEX we might see some attempts to kind of get our momentum back. So some initial thoughts right before I have our options data for next week. Yeah, let's look at some of your comments here. Let's see. Don't understand how people don't roll them. This is a good observation here from Rehards. So yeah, I mean, this is a good thing to point out. I mean, it cannot be ultimately profitable to roll a short dated call. Like if you bet on a short dated call, or if you have calls from a while back, like let's say you use it as a hedge or something like that. In terms of something like tax advantage, it may be more worth it for you to sort of take that as a loss rather than pay money for a new call trade down the line. Like if you don't have one, right? Like if you don't have like, oh no, like I think, oh no, I want it to go to this price, so let me just buy the next calls. Like, I certainly don't target call entries based on like, oh no, like I want more time on this particular call. I mean, that's not a typical strategy that I use. Doesn't mean that people don't use it, but if I'm looking for like a long call entry or something like that, I'm definitely looking for kind of the ideal price and IV conditions. And if something doesn't work out and it's getting close, like for example, sometimes I'll just kind of take very small sort of flyer bets, like interested on something, I'll close a particularly good trade and I'll see, okay, there is a cool technical setup on something. Let's see if it works out. Let's see if it goes off. I tend not to do that. I do that with very, very small amounts of money. But okay, is it really worth it for me to necessarily close that, or do I want to hold it to the end just to see what happens? Sometimes I'll make that decision. I think sometimes too, like, yeah, people might not just want to continue that same trade or do that same call for a later date. But that's a good observation there. Yeah, Masta makes a good observation there. Yeah. Is this StreamYard information supposed to be there? Oh, I don't know. Oh yeah. Yeah. Okay, so some of you guys mentioned during our last stream you're interested in potentially asking some questions. If you guys have some questions, go ahead, put them in the comments, and I'll bring them up on screen. We can talk about them a bit. Maybe while you guys think about that, there's a couple things actually I wanted to bring to your attention in case you did not have a chance yet to check out my video earlier from today. There are a couple resources I linked there. So if you go into my video earlier from today and you look in the description section, there's a couple resources that earlier in the week some people had asked me about how market maker hedging and some of the options Greeks like accumulated gamma exposure, which I talked about a little bit earlier today, played into the 2021 sneeze. So there's some resources by user on Reddit that's not terribly active anymore, whose name is JN_KU. If you go into the Superstonk library of DD, you can find this guy's old posts that kind of walk through this and how he was understanding that at the time. I think many referred to him as Jinku. You can find, there's like one of those fake ebooks or something that's a collection of his posts there. So that's basically where I first was introduced to the idea of market maker gamma hedging. And after I was introduced to that by sort of happening upon Jinku, I think through, I went down some rabbit hole, I remember at the time, through Wall Street Bets, and then ended up at this guy's page. And then there was a community that formed basically around his breakdowns with market maker gamma hedging, called, the name was r/maxjusrisk. It's still around. It's not active. It's pretty much a dead community. But it was pretty active during like 2021, where we had a ton of these squeezes, like a lot of squeezes after like the COVID stuff. And a lot of them were options induced squeezes, right? They were gamma squeezes. So there's, I would check that out. That's linked in my video from earlier today. And then, yeah, I also linked an article from Spot Gamma. So this is actually how I found Spot Gamma, which is where I basically learned how to read gamma exposure and trade off of that. It took me a while to like get it right and like get it's like you can read it, you can analyze the chart, you can get that. Doesn't necessarily mean you're gonna accurately trade that. It took me a number of years before I kind of got that consistently. Yeah, I would check that out. And their article from February on the January squeeze and the degree to which options trades played a role in that. So that's both linked in my video from earlier today. Yeah, let's get to some of your questions. Okay. Let's take out Master first. I have January 20th, 35 spreads, trying to capitalize on moves and pocket the decay. Okay, that doesn't seem like oh, the question's here. If we spike to $75 before expiry, will my IV on the sold spike higher faster than the bought side, so I won't capture the full $15? I don't know the answer to that. I would go ahead and check out, like, I don't trade spreads, but I would check that out maybe with an options calculator, maybe a more advanced one, like the one on Unusual Whales, something like that. What do I think of James Rowland's melt-up theory, which is expected to play out in the next 2 to 4 weeks? He has a price target of $130. So maybe is the short answer to that. I would say that. So I don't know the mechanics of James Rowland's theory. What I sort of do see as a potential overlap is something like, mechanically, what would cause that? So first off, it does seem like we have some anticipation of some sort of big upward volatility event potentially taking place in the early part of next year. I think there's something else that is driving this type of upward movement. Maybe it's something like settlements with respect to swaps, or closing positions or something like that. As far as what's causing this particular bull run from October into November, I suspect basically my insight into this is something like Roaring Kitty potentially signaling through his kind of symbolic elements, his memes, something like that, that there is some sort of mechanical thing going on behind the scenes, and that what we're seeing in particular with this run up is anticipation, independent of Roaring Kitty, independent of Keith, but basically also having some sort of hunch with respect to those expiries. I think the leading theory that kind of makes sense to me, based on some of like the swap data that I've seen, is there is supposedly a very large notional amount of swap value that is sort of coming to either expiry or fruition. I don't know swaps particularly well. That could result in some sort of major upward volatility event if the price is not below like a certain point by the end of December. So I think part of what we might be seeing in terms of this bullishness is and has been a very sort of long-seated attempt by potentially bullish institutions that know that this is coming, that want to push the price up to a certain level where it would threaten those potential players and they could make a lot of money. That's basically, theoretically, speculatively, as I understand, what would kind of need to happen mechanically for something like that to occur. I don't really know where he's getting a price target of something like $130. I mean, if it is going to be a recall and we go back to like where we were, if there's something algorithmic going on there, like I just don't know necessarily how you would derive that. I guess it's possible, but yeah. So we have from Derek here, or Derek Tse. Nice to meet you, my friend. He says, you mentioned that a good amount of shares were borrowed today on top of the shares that are still available. Do you think today's price action is the effect of all the shares that were borrowed? I think certainly there was a fair amount of price action today that was driven by that shorting. I would say whoever shorted the stock today did not do so in a way that was particularly, what would I say, salient. I mean, if we take a look sort of at this early portion of the day, right? I mean, yes, there was some shorting that came out kind of right away. I would consider something like this concentrated amount of shares to be something like selling, something like shorting. I would consider something like this candle here to be the completion of this kind of run. I don't know how many of those shares that were borrowed early were deployed throughout this. I suspect that many of them might have been borrowed in order to counter something like an upward volatility event, something like if a bullish institution or if a catalyst did really happen today, then that institution would like to have those shares on hand to control the price. And one thing that I've noticed in terms of controlling price action, and then I guess we'll talk about whatever just happened right here, is that institutional shorting, or I guess maybe market maker tied in shorting like that. I don't know actually who's doing this sometimes, but if you take like the example of the shorting we had, not this Monday, I guess last week Monday, something like that, last week Wednesday, this type of shorting is a bit conspicuous to me because it targets key levels, right? It'll be shorting, it'll be a lot of shares that all of a sudden will show up right away at, say, key options levels, or key technical levels intraday, when day traders, when people who are potentially entering trades expecting reversals in the price are trying to enter. And so by doing that, it sort of triggers a lot of maybe stop losses. If people do enter positions right there, it will immediately knock them out. It'll cause kind of this cascade effect of selling to amplify the effects of right? To sort of break the expectations of who's trading in that moment, and then cause some hesitance, right? Force people to go, ooh, and now I don't understand what's going on. I thought I had a structure. I thought we had sort of a system set up where I had a degree of predictability, where I had some confidence in our navigational markers. But right there, when we had shown support, all of a sudden the bottom dropped out. We had something like that a little bit yesterday. It was just a little bit yesterday, not a lot. But yeah, is this the 1 minute chart? Yeah. I didn't see anything too abusive, but this was a bit more natural looking. But I would say that there was quite a bit of shorting that sort of drove this down. And at this point, it didn't need to be, I guess, too aggressive, insofar as it could happen at a gradual rate. It could influence the options market like it did. We did have a pretty bearish trend at that point. So there didn't need to be a really excessive or aggressive amount of shorting at that point. So that's basically what I saw there. But certainly some price control insofar as wanting to make sure we stayed in that lower bracket. Yeah, brilliant. We are climbing after hours. What do I attribute that to? That's a good question. I wonder if there was some covering maybe that happened here. This is somewhat strange, right? Like maybe somebody, if this is somebody who held their short position into the after hours and then decided that, they didn't want to cover when the market was open, to the extent that this could potentially influence options trades. So part of the reason why you would, I guess, wait to cover your short position until after hours is if you short during the day, you introduce a bunch of demand into the lit market. And so the options market will often copy where those are going. They'll try to catch the tailwind of a big short order like that. If you short during the day on the lit market, you can get options. You can get the options market to follow you as like a tailwind and give you like some extra force downward on that. But if what you want is to keep the price suppressed, if you want to keep it down, then you can wait, I guess, until the after hours when your covering event would not stimulate buying in the lit market. It wouldn't stimulate options trades to kind of dogpile on what you're doing or follow your tailwind. So, in the after hours, you definitely run the risk of lower liquidity, but yeah, it's not even that big of a trade. It only looks like it was like 20,000 shares. I don't know. Hard to say. I don't know, right? A lot of this is speculative. Hard to say. Ooh. Maxi King, great question. Is there a list of websites that I use for my research? Do I know any alternatives to the paid services that I use? So Chart Exchange, which is one of the sites that I use, is free. That will give you max pain data. That'll give you options open interest. That will give you, that'll show you shares available to borrow, which it draws from international brokers. So Chart Exchange is really good. I'll put this in the chat. Chart Exchange. Richard Newton also uses Chart Exchange. That's actually, a lot of people use this. Let's see. What else is free? Alpha Query, which I use for 10-day mean implied volatility. Alpha Query is free for a number of days to have sort of full access to the site. After a while, it'll restrict you down to sort of lesser timeframes, and then it'll ask you to subscribe. You can simply open an incognito tab, and it will just sort of reset that for you. It won't sort of unlock the additional features there. So, but you can use that for free for a while. You can see, like, depending on who your broker is. So like you can see gamma data. It's just not like calculated and tabulated in a super accessible form. Where would it be? I think it's like under product depth. here. So no, not GE. There is a way to see this. I remember. Okay, here we go. Yeah, you can like plot. It's not super helpful, right? Like you can like select custom charts and like it'll plot this stuff for you. These charts have never been super helpful for me, right? Because it doesn't like aggregate these values. One of the great things about unusual whales, when they take gamma exposure, put gamma exposure rate, combine delta values, they'll show you charm values. Like they'll aggregate this data so you can see net values, and then I sort of mark them up. I draw on them based on some of the things I've learned from Spot Gamma. It's just, unusual whales is a lot less expensive than Spot Gamma. Spot Gamma has some more advanced tools that are particularly useful if you know how to use them on like indexes or indices, I should say. So like SPY and SPX. I don't trade indices at the moment, but they've got some pretty advanced stuff they're rolling out there. So yeah, unusual whales. I think you can even with their basic package, like their $40 or $50 a month package, you can get the gamma data and stuff that I take a look at on a regular basis. I don't know of any spots that provide that for free, unfortunately. Yeah. Let me go back over here. Let's see. Eve Awesome, did I pay for Spot Gamma Academy courses? I have not yet. I have considered going into some of their more in-depth courses. I had basically learned some of the options basics. Well, so their options basics course originally, if I'm not mistaken, they had for free. There were also there are a lot of free basics options things that you can find online. I guess where their advanced courses really, where they sort of diverge from the herd is in some of those advanced courses. I have not done their super advanced one, but through watching a lot of their videos, following some of their publications, like reading their newsletter every week. They have this newsletter that they put out every week, and if you subscribe, I think they give it to you every day. And sort of I learned by reading this letter how to basically how to understand these different data. It took me a while to sort of figure out how to apply them practically, because in their newsletters, like they don't come out and say like, first you look at this, then you trade this. Like they don't do it that way. But eventually if you sort of induce their analytical methods, which is I suppose what I did, I figured out how to take that from the way that they analyzed the indices, so like SPY, QQQ, things like that, SPX. And then I started just doing that for a number of years. I started trying to do that and trying to figure out like what sort of equities it was possible to accurately and consistently do this kind of like options analysis. And alone it wasn't enough. And then I learned enough kind of different ways that it sort of helped me become a usefully profitable trader by approaching it from these different angles. So definitely start out by taking a look at some of their free stuff. Let's see. Okay. This is a good question. Josie says, I got April 18th, $33 strike calls today. My first time. How would you play them? Advice. Okay. So I'm going to take a sip of beer for this, but cheers, by the way, everybody. I'm drinking, all my Polish friends. Oh yeah, the camera's over here. I'm drinking some Książęce Złote Pszeniczne. Very good. Golden wheat. This is not financial advice, but if I would say, for me, what I look at when I'm looking for a long call trade, is the first thing is I usually say, I'm not looking at a long call trade. That's number one. I really, really rarely enter into long call trades unless I really, really like the conditions. I try not to be too active of a trader. That's basically, that's sort of my taste there. I do a lot better with sort of managing an investment with a pretty conservative wheel approach on top of it. And then with sort of those extra profits that I have, if I see a good opportunity for something a bit farther out, like I did in October for January, I might take that opportunity. So finding the right opportunity is number one there. That being said, if I had, I guess, April 17th, so April OPEX is the 17th, $33 calls out of the money. I mean, yeah, they could work, right? So like I would think about what are the circumstances under which I would be in that trade. I guess if I thought this is as low as IV is going to get, next week or in the next 2 weeks, we're going to get like a 13D from Ryan Cohen or something, like he's increasing his position size, right? Because insiders can start buying now. Or Roaring Kitty is about to announce that secretly he's accumulated 36 million shares of GameStop and he's joining the board, something like that, right? And that, the requel's on, the melt up is on, you're really betting on these, something like, these swaps expiring or something like that, right? Which, hey, maybe you have a good thesis for that. Maybe you have a good idea of how that would happen. And you're trying to capture a particular move in a particular time. So like, that's how I think about, I guess, using long calls is like using them as an instrument to capture a certain amount of value from a certain move around a certain time, right? So I think you are time advantage with those, Joe. You do have, you've got some decent time. Those are probably not going to lose too much value in terms of time over the next, the next month or so. I think April as a sort of target for something like a long call, if you're trying to capture value, if you think that's going to come in January or something like that, I would be wary of your position size. I'd be wary of how much of your portfolio that trade represents, that position represents. I don't like to trade long calls with, like I said, typically it's like more than 1% of my portfolio. I did make an exception because of my conviction of betting on the Roaring Kitty catalyst in October. I was like, I think he's gonna do it, right? I spent 4 months like being like, he's gonna, October 29th, he's gonna do it. And it's going to go from like, several months. So that ended up working out. But I would say if a good practice that I practice, again, not advice, if you, depending on how much of your position is there, if you double your position, just sell half of it, right? Eliminate your risk. If something like that should happen, if you get a really volatile day and you get up in those, and they double, like sell half, right? As soon as you can. As long as you're waiting on, if you think, when is this value movement going to come in? Is it going to come in mid-January? Is it going to come in late January? Is it going to come in early February? Like whenever you think this value movement is going to come, like you have a thesis, you have an idea, like this is the specific value I think is coming in the future. This is what I'm trying to capture. I would say be prepared if in the time that you specify that you think that value is going to come and you don't see that value coming. Like for example, if I were trading this April, I'd be looking to capture something like January, early February kind of move, especially January action there. And I don't see that January action. If it's like February and I don't see that and I've still got, value and we haven't really moved up higher, then, maybe I'd think about repositioning those, scaling down the position size, reducing risk, something like that. It depends, I guess, what your overall strategy is, what you're doing with your portfolio, like what other types of trades or what other strategies you're pursuing that would depend on, that would influence how much risk you're willing to take with that position. So hopefully that's clear. You can let me know if it's clear in the comments, and if it's not, then I can elaborate on that more. Doesn't look like any borrowed shares are returned all day. Yeah. Oh, 3. Okay, cool. I don't know what size of your position, what size of your portfolio that is, how much of your portfolio that is, but as long as it's something that you're comfortable with in terms of, what do they say, your risk tolerance, something like that. Yeah, you have to go, I guess you have to go with what you're willing to lose. Like I basically don't take options trades unless, unless in my mind, I'm basically willing for that amount of money to go to zero is basically how I do it. Jason says, what are my thoughts on the December swaps, which Richard discussed today? Yeah, I don't know a whole lot about swaps. I think swaps are probably, like, these swaps coming due are probably the most convincing market mechanical explanation that I've come across for why these really huge upward volatility events take place. Insofar as I believe that what makes most sense to me is that institutional players know that these swaps are going to expire, and they're going to influence the price in the sense that these swaps will come due. There will have to be unwinding of hedges, something like that. And this is going to cause an upward volatility event. Okay. Institutions know this. Institutions see certain filings or figure this out. They know this is going to happen. They, at the same time, can influence the price before they know this is going to happen in such a way as to amplify the degree to which an upward volatility event takes place. I think that is perhaps what we are seeing in this price action now. I don't know necessarily that, say, this type of move that we're seeing, this move since, say, October and throughout November, maybe it had something to do with a smaller amount of notional swap value coming due. But I suspect as well that they're, based on all of the institutions that we saw go really long in the September 13F filings that were published in mid-November, I suspect that not only are these institutions looking to capture value in that event, but they're also looking to, through their trades, move the price up to such a degree that it might cause whoever might be disaffected by these swaps to be disaffected all the worse. So there's potentially that's in play. I don't know anybody in particular, but something like that. Then we have another layer on top of that. So you've got the moving the price or controlling the price, influencing the price through very large orders well ahead of time to position it such that the swaps will have, when they come due, this very big upward volatility effect. And then positioning options on top of that in such a way that when they become due, it feeds into this upward volatility, and then this options volume attracts other options buyers who get excited, who go bet on things, right? Retail is usually the last to join, but retail jumps on calls, right? So basically, in this Spot Gamma article that I referred to at the beginning of the live stream, and Jin Ku's writings, what happened in 2021 was, okay, so you had this big upward volatility settlement event, right? Ryan Cohen started buying a huge amount of GameStop stock. The stock was heavily shorted. There were all of these settlement issues. Largely what I suspect, or what it seems to be the leading theory of what drove price action between August and December, especially in late December when Ryan Cohen doubled his position after Q3 earnings, was that it was extremely difficult for institutions that had over-shorted GME and were attempting to seller box it to actually find real shares, to locate real shares in order to settle his purchases. So they were just walking around with all kinds of FTDs. GME was on Reg Show for a while. And in January, what started to happen was options buyers and put sellers, call buyers and put sellers started to kind of push things farther, right? Push the envelope. Okay, then it's like, oh, whoa, well, we don't want to settle at these prices, so let's try to short it down from here. But then that backfired. And what you saw was a series of, I talked about this a little bit earlier in today's video, this sort of what's called a gamma squeeze, which is a feedback loop between bullish options trades and market maker gamma hedging in the right proportion and at the right rate of purchase, that it sustains itself such that it pushes higher and higher strikes into the money, which requires more hedging on the part of market makers, because as the price goes up, right, they have to, as calls move in the money, their delta values go up. Market makers have to go out and buy shares in order to account for those delta values in order to remain delta neutral. However, as that happens, right, options buyers, call buyers, traders will come in and want to profit off of that movement while market makers are pushing the price up by hedging those bets by buying shares. So they'll buy calls, which means then market makers have to go out and buy more shares to hedge those calls, which go in the money. And what happens is you get this chain reaction where it's, you know, traders buy calls, price moves up, market makers hedge those calls, calls above them go in the money, delta values go up, market makers hedge shares, call buyers come in, buy new calls, et cetera, et cetera, et cetera. And what we saw in January of 2021 was call buyers maxing out the options chain on consecutive days. And when this occurs, the market makers then, who try to use these hedging strategies in order to remain delta neutral and have the majority of options contracts expire out of the money so they pocket all the premiums, their only option is to, well, they do two things, right? So they increase implied volatility in order to incentivize selling, so that, you know, call buyers will exit because their, you know, IV has jacked up the prices of their contracts so much. And number two, to extend the options chain, to keep walking the options chain higher and higher and higher with new strikes that are farther and farther out of the money, so that buyers will give them new premium and allow them to pocket credit from these options purchases to go and then fuel their hedging, so that hopefully at some point these contracts will be so far out of the money that they'll be able to kind of disperse the buying pressure, like this euphoria, they'll be able to disperse that up the options chain, and eventually the momentum will run out. And then as the price collapses, they'll be able to sell their hedges and they'll be able to eventually pocket all that premium. So that happened too many days in a row where that wasn't happening, where the options chain was maxing out in January of 2021. So that's why they turned off the buy button, essentially, was because there was no other way to stop that chain reaction from happening. Because, right, they were jacking up IV to, like, you know, 300 something %, hoping that, oh, well, we'll just increase this, and then these call holders will eventually sell their calls, they'll sell them, they'll close their trades. And because everybody who was buying at that point didn't know how to trade options or even know what implied volatility was, they just kept holding it and, like, watching the numbers just rocket up. So, you know, dumb money almost broke the market in that case. So I think insofar as the swap question is concerned, you know, I think potentially, if these are going to happen, right, if these swaps are going to open up and there is going to be this kind of requal type scenario, that what we are seeing now is an attempt to kind of position that, maybe by institutions in the right way, so that it will be carried right by this kind of gamma squeeze type activity that will make, I guess, that it'll increase the upward volatility of those swaps coming due, something like that. Does that make sense? Rehertz asks, when was the last time I made a trade on GameStop? I trade GameStop every week. Most recently, I sold out of the money calls earlier this week. To what I have to assume is GameStop's designated market maker, Wolverine Trading. The fact that that stuff gets filled instantly when I put in a mid bid, right? Whatever the bid is, right? There's a bid, there's an ask. I usually, if I'm going to go ahead and sell calls on my share position, I usually pick something outside, like above the call wall, decently above the call wall, and yeah, I will sell calls on my position, knowing that market makers will conspire to keep the price below the call wall. Yeah, they sure do buy them. They buy them. I seriously doubt it is. There's just some retail trader that's sitting around being like, man, like when is this, like, who's going to put up these calls at the mid of this strike that is, you know, arbitrarily above a call wall that I don't know exists? They get bought instantly. So, you know, Wolverine Trading, I like to think that's who I'm taking money from. Yeah, that's a very profitable trade, very high probability trade. It doesn't necessarily net you a lot of premium per trade, but it's very consistent, very high probability. And it is the market maker's job to provide liquidity. So I allow them to provide liquidity to me in that sense. The last time I would say the last time though that I purchased long calls was when IV was very low in GameStop. Do I still have my January trends? I significantly reduced my January position on this when we started to move off of this this top, this big top in the early 30s. I definitely took some profits on that. What other resources like Spot Gamma have you used to learn and would recommend? Another guy, actually somebody who was very helpful for me in terms of learning how to read technicals, is a guy, I'll put this in the chat too. His name is Nico Wrench. So he's one of these guys with like a premium Discord group, and he does a ton of, a lot of the stuff that I learned was from his free videos online. I think he still does those, but he was doing a lot of these back in 2021. I think when he was just getting started as having like this trader training group thing like that. But yeah, but I took sort of some. It wasn't a one-on-one thing, but I joined his Discord, and he struck me as a person who more or less knew what he was doing. And I learned, I learned how to do technical analysis from this guy, and I learned how scalping actually works. Like I said, I don't have a super active trading style that requires a lot of work, a lot of focus. I also don't like to, in particular, like right now, I love having my focus be on GameStop. Like I like to do very, very deep analysis on one ticker. GameStop's also great because there's a community hive mind that's also like bringing up ideas and like, you know, posting stuff all the time on different sites. You don't necessarily get that with other stocks. So I like having this huge amount of information to go through to sort of have really high conviction in the type of stuff that I'm doing. Whereas if you're going to take a day trading approach, like a scalping approach, it's like you follow somebody like him or like Jake Vujastic or something like that on Twitter. You have to watch a lot of tickers, and you like care about only the charts. and you set up kind of a probability. You have to like do this probability analysis where you look at certain situations, you ensure that whatever stock you're trading has sufficient options liquidity, and then you test yourself in certain situations, and then you just sort of repeat those. You figure out your win-loss rate in those situations. You try to project that forward, that type of stuff. So like that's his trading style. That's not my trading style. I did not particularly like that trading style. I like to yes, I like doing this. But to enter a type of trade like that type of day trade is like when you're in, you have to be locked in. And if you have like other stuff going on in the day, like you can't be doing that type of trading style. But that being said, learning that a large number of traders trade that way, and that type of trading is possible. That it's not only possible, but like full-time day traders, that's how they do it. That gave me a lot of insight into understanding how price movement, how like an extra component of like the human element in terms of how option sentiment comes to affect intraday price movements, and how technicals, especially how intraday technicals like VWAP, the volume weighted average price, play into intraday price movements. Why these like reversals happen when they do, and why we get these kind of like little channels that kind of form up, something like that, where it kind of bounces back and forth. So I would check out some of his stuff. If you're interested in learning that, I would definitely say be careful with taking up day trading. It's really hard. You will definitely lose money. Like if you take money and like go try and do it, like it's very difficult. It's very counterintuitive. There's a lot that you have to prepare outside of actually doing the like click the buttons. It's very easy to lose money. It's very easy. Tom says, once those swaps are rolled, sorted, whatever they do you think that we are likely to see a price drop down to pre-October 24th levels? That's a good question. I would say, okay, why would something like that happen? First off, like if we look at what happened in 2021, it took a very long time for the price to move back down the chain there, and move back down the ladder. And a lot of that occurred because GameStop also had no fundamentals. Like really, in 2021 and 2022, the fundamentals were bad. Like it was just like, is Ryan Cohen gonna pull this off? Like who knows? They did that like NFT thing, and then there was the stuff with like Bed Bath and Beyond, like that was going on in the background. They were posting loss after loss after loss on the quarter. Like definitely like the bear case in those years, they could point to the fundamentals and be like, this company is not worth this. This company should be shorted hugely. It's way overinflated. This is ridiculous. I don't know. Like you have a company that's not losing money. The company is profitable. They're making money off of their investments. They have no burn rate. And the company has $4.6 billion in cash that they're not coming out and saying what their intent is, whether it's, the game Shire stop away approach, or it's, what would you say? They're just going to acquire a couple different companies and do mergers or something like that. Yeah, like, don't know, but the company underneath is like only trading at 2x cash right now, or slightly, not even like 2x assets, right? It's just 2x cash. So it's less than 2x cash and assets. Like that's not crazy. That's not crazy inflated. And the objections are just like, well, we don't know what the vision is. So because we don't know what the vision is, we don't know how they plan to make this more profitable than it is, then we see some revenue decline, even though we understand that's about shoring up unprofitable locations. Where before you could move the stock off of those really high prices on the excuse that the company's absolutely not worth these prices. It's much more debatable now, and especially if Ryan Cohen is moving forward, if we go way up and he does like another at the market offering and the cash pile doubles or something, yeah, like I don't think you're gonna see prices too much lower than like 2x cash and assets, especially if you do start seeing more and more profitable quarters going forward. So I think I'll say this, I won't speculate too much, but I'll say I personally am comfortable with potentially being able to see that type of thing coming, is I guess what I would say. But I guess, again, right, that's still speculation. Eve Awesome says, you showed a chart the other day that showed a purple line that showed the calculated price options. Yes, at different strikes should be compared to where prices were. Where do you access this chart? Yeah, so this is the theoretical options price. So I have this so if you trade with Thinkorswim, let me see if I can make this a little bit bigger. I want this. I want this. I want this. Yeah, so in Thinkorswim, so just to show everybody what Eve Awesome is talking about, let's take the 20s here. Right, so for example, this only shows up when you put options contract tickers into Thinkorswim. At least this is what I use for my trading platform, so something like this. So, so if you take this, you can copy it, you go over to the chart, you can put this directly in the chart in the bar here, and you'll see this come up. And she's talking about this purple line. Okay, so this is what's called the theoretical options price. So this is, I think this is a study. I forget exactly where yeah. So in my studies, so if you go over to studies, so on Thinkorswim, studies is how you get like these different calculated lines. So let's go back to GME. So like, for example, VWAP. This is my VWAP study. So it gives me the blue line is the volume weighted average price. And then I get the red line is volume weighted average price plus 2 standard deviations. And the lower line is volume weighted average price minus 2 standard deviations. We've got regression channels here that we can draw. We've got the moving averages. So these, if you go up into Thinkorswim and you check out studies, right, you can see we've got all these different studies, right? There's so many studies. Look at all the studies, so many studies. I just use these studies. Sometimes I'll play around with some stuff. But if you go in, right, and we put options contracts in, go back to our charts, go back to studies, and edit studies again, you will find that there is one called theoretical options price. It's in the list here. You should be able to go down here. Yeah, theoretical options price. And so that's going to give you, I suppose, it'll tell you how it's calculated. You can go in and it'll show you like, yeah. So let's read it. Study plots the value of the options price function for the chosen option symbol. The study parameters in the data use historical market data and information gathered by Charles Schwab and Company. All output is for informational and educational use only. It is not an investment recommendation or advice and should not be relied upon in making the decision to buy or sell a security or pursue a particular investment strategy. So remember that, guys. But yeah, I mean, this gives you the theoretical price. So occasionally, this can be used to indicate when an options contract is undervalued or overvalued. I don't use it that much when trying to make decisions for buying. But you can see here, right, that it doesn't always, actually that's a little bit far back, right? Let's go, where were we? Before earnings. Actually these were, was this the right one? Yeah, so before earnings, right, the price of $30 calls was overvalued. So the actual price was decently above, maybe by about 20% above the theoretical price, and then that flipped afterward. So it can give you an idea in terms of, right, where of course the day before we were appropriately valued, right? Our actual price was converging on the theoretical price. So that can tell you, say, for a particular contract, if the IV value as it applies to that contract is shifting the price away from what is ideal, right? How is the market actually pricing these right now? Is there too much demand? Like, is something going on with this contract? So, for example, you might have been able to figure out before earnings that was a good contract, say, to sell into earnings, because basically for the whole previous day, it was inflated in terms of its value, is overvalued by about 20%. We know that earnings effect, that IV dip often comes in, and sure enough, actually this was for the prior weekend. These ended up going up a bit. But not the real value though, not the real value. The theoretical value went up, but the real value did not. So, like I said, I don't use that too closely, but it can give you, it's another data point that you can potentially use. I use this sometimes. So if you use Thinkorswim, you can find that in that particular mode. If you don't use Thinkorswim, you can check and see if your particular broker or trading platform does something differently. Very good question, though. Mexican King says, what are my MOAS numbers? Lambo when? Great question. I don't know what numbers are, is the thing. So I couldn't possibly say. Yeah. I don't know why you would use a number. It just seems very impractical to me. Yeah. Let's see. Master, I wasn't around during the 2021 sneeze. Not sure if you were, but I'm a bit worried right now. If we squeeze it, MMs might not let me sell my calls. So in 2021, you couldn't buy them. And actually, in most cases, they forced you to sell your calls, is what happened. Actually, a friend of mine who I was trading at the time had a number of GameStop calls. And actually, one of the reasons why he ended up profiting pretty considerably from the sneeze was that his broker forced him. I think, yeah, he had Fidelity. Fidelity forced him to liquidate his call position, forced him to sell it. And this was because Fidelity was very worried that people would exercise their calls and then they'd have to deliver on share obligations and it would send the price even higher. So they forcibly liquidated a bunch of people's calls. Robinhood may have done that too, actually, but that's a good question. So they wouldn't stop you from selling your calls. They would stop you from buying, I think is the case. Yeah. They could cash in on their calls. Yeah, actually, they were worried about people cashing in on their calls by exercising them, is what they were worried about. So Thomas Petterfy came out and said this in February, that basically if the people buying options knew that they could exercise them, all that they had to do in order to send the price, quote, into the thousands was just tell their brokers that they wanted to exercise their options. But most people who were betting on options only knew about them as like a gambling instrument and didn't know that they could do that. For the same reason that they didn't know that they could, that like implied volatility going like into like 350% meant that like that's an extremely rare opportunity that never happens, that your options contracts were insanely overvalued in terms of their extrinsic value, and that like, oh my gosh, how could you not sell them? Because they didn't know, like they didn't know that they could do that, but then that they should do that, or that the strategy or the tactic, that like the smart decision would be to do that. They also didn't know that they could affect the price by exercising their calls. So that didn't happen. And everything happened too fast for them to figure out that they could do that. So yeah. Rehards, I am going to make a video this weekend about VWAP. So I'll make a little short weekend kind of deep dive into that. So that's a good question. I'm going to save that for this weekend. Maxi King. Oh, did it not show the studies, guys? Were you not able to see the studies when I showed them? Maybe that was like a pop-up box. You can let me know. When Lambo. I guess when I get to Green Bay, Wisconsin, and isn't that, that's Lambeau, right? Lambeau Field is in Green Bay, Wisconsin. Yeah. So whenever I get to Green Bay, that's when the Lambeau. Yeah. And then, yeah, good question. I guess this will be our last question for today from Yenseo Kang. Yeah, how concerned should traders be about next week's Max Payne? So the thing about monthly OPEXs is they are going to be a bit lower. If since we've been trading up for a while, right, the Decembers have been out since early October, maybe end of September, something like that. I ended up writing about this. I remember that when the November and December options chains came online, I remember talking about this. Tom, you might remember this from my articles, but I specifically remember at the time that I looked at those options chains and I noticed how much shorter they were. They were a lot shorter, right? So earlier ones, back because of the May-June stuff, like they had extended them all the way. Market makers extended those all the way up to $125, just like we have coming up in January. And I noticed that in November, the November one was squashed down to only up to 45 at the time. And when the December options chain came out, it was only at $29, was as far as they extended it. And so that kind of gave me a tip off. I was like, ooh, are they like, is somebody trying to encourage here? Like, because, market makers, GME's designated market maker, Wolverine Trading, has an investment arm. They simultaneously do run two enterprises. So one of them is like active investment. They go in, they make purchases, like they do stuff that is, it's active, right? It's like Renaissance Technologies or an investment firm, a prop trading firm, something like that. And then they have, they have a market making arm, which is Wolverine Trading, I suppose. And as I understand this, technically they're two different companies, but they're not supposed to collaborate to help the other one, but they definitely can do that. So I thought perhaps that, okay, this was an indication that these later options chains, maybe in November or December, that maybe there was some sort of idea that, oh yeah, there definitely is going to be some upward volatility here, and we're going to structure these options change in such a way that it would actually maybe encourage something like that. So I thought that back in that's the thing, Tom. It got shortened so much. How could you only extend the December up to $29? That was ridiculous when that came out. It took weeks for them to even add a $30 strike to the December chain. So what happened in there for a long time was that you had this concentration, a lot of those early calls that were purchased for December and early puts and stuff were all down around $20, and in the lower 20s range. There was not a lot sold that was higher because there wasn't this ability to sell stuff higher or like, do puts higher or anything like that. So the monthlies are going to tend to be lower. January as a quarterly and yearly OPEX, right? The max pain for January right now, it's our largest options expiry, and the max pain there is $20. So, I mean, I don't know the future. I would say that, yes, it is probably in market maker interest to have a lower close. To see, I guess we'll have to see for data. I thought definitely earlier. If we go over to, let's go back to our chart for a sec. Make this bigger for us. So let's go cat day. So in here, I thought we had a real chance, like a very strong chance of going straight down into like $24, $25 into earnings. And I said that as much. Like I said that in my articles back then too, when I thought this was a real possibility. Because really, like when I say if it weren't, this is like one of the first videos I ended up posting. Like I think I wrote it. This was like one of the things that like got maybe the day I got banned from Reddit, the day I got suspended and my account got wiped and I was locked out of it from Reddit was like a day I talked about this in particular was, hey, look, there's this manipulative shorting happening here. Huge numbers of shares are very clearly just being dumped to force the stock price down. They're trying to move us out of this bearish regression channel. The way it was drawn up to that point too, like they had just basically done it for a day. So like if you shorten the regression channels back to where they were, let's kill the extension here. So if you move this like back here, before like the kitty candle, let's see if we can, wait, hold on, I have to change the, if we move this back to right here. Yeah. So if you look here, right, we moved, like we were definitely like, bears had pushed us down here. Like they pushed us out of the bullish regression channel. And I said basically like, look, there was like, this was the day where we got some manipulative shorting, a couple 100,000 shares, but we got that huge counter order in the option, like 144,000 shares of the ask that was just rerouted to a dark pool. So it wouldn't affect the price. Like that's what happened here. And I was like, okay, unless bulls basically reclaim this territory, like move above this line, then we're looking at, then they're in control. Their paradigm's going to assert itself. And then basically, by December OPEX, like we're going to go hit the 204-hour moving average here. Like we're going to hit this. Maybe we get a reversal off this in a day or two. But, then we kind of just trade, we go into earnings slightly above 25. But then if, then there's a chance that earnings trades down, right? They short this under this line under earnings. That was definitely an option. And then Roaring Kitty's tweet came in and just way reversed that. But basically what I was looking at that point was like, oh yeah, like now with all of this in play, unless there's like some kind of angel catalyst that comes and does this, then we're going right into the 204-hour moving average, in which case maybe we consolidate. I think I said this, I thought we would potentially consolidate like around 25. If earnings were good, then we would kind of stay above there. But that I could see us, back when, before this happened, that I thought potentially we were, headed for that type of close. I don't think that as much now. It's not that it isn't possible, but again, like there's always risks for bears to go and manipulate the price with a lot of short shares. Like there is risk to doing this. There's, as we can see too, like, Roaring Kitty has, made himself known. Then, right, he had this tweet that everybody was super like reposting around Halloween, which is bear beware, you're in for a scare. Which I suppose, like, there was a guy like on top of a hill who had a briefcase, and like the paper came out and everyone's like, oh, it's his 13G filing, and yeah, something like that maybe. But two, like, he can do this. Like, he doesn't necessarily do it predictably, but I really think that he does maybe these type of tweets or something like that, or at least this one. He could have done it at any one of these particular days. Like, maybe he would have waited until Friday, and it would have caused, a gamma run on a Friday. It would have caused a huge reaction on a Friday, and market makers would have been like, would have panicked or something like that, to make sure that the price got walked down. But I do think, I really thought he targeted that in particular, looking at the technicals, knowing what I know about how much stock he puts in the technicals. I wouldn't have been surprised that he did something like that, specifically do that. So, he's definitely let the market know that he knows that he has this ability, and he himself is a wild card that now institutions who are used to just having free reign, or going, butting heads with each other, they're used to just having to deal with that. Now they have to account for him. Now they have to account for the risk that they can't just short this thing with impunity, that he can do stuff like that and then really, really make them regret having entered into manipulative short bets like that. So, yeah. So that's my thoughts there on Max Payne. I'll have more to say about this on Monday when we see our new options data. We'll take a look at what that looks like. I'll get some fresh eyes on that. We'll get these contracts off the board. I'll put some thought to it over the weekend. Right now, I'm not super worried, but yeah, me too, regards. Yeah, and very last question, of course, is that Kirin Ichiban? No, this is in fact, as I mentioned. Oh, I want to be this. This is, yes, Książęce Złote Pszeniczne. It is a Polish beer. Wheat beer. It means wheaty golden, something like that. It's very good. But yeah, I think we'll bring today's live stream to a close. I think this was a success. Cheers, you guys! Thanks so much for tuning in. I hope I was able to share some information that will be helpful to you guys. I hope to do that in the future. Please go ahead if you have ideas or future questions, things that you think would be good for like a weekend sort of deeper dive video topic. If there's something you want me to think about over the week, if you think would be helpful, go ahead and shoot that my way. Definitely happy to do that. Very thankful for you guys. Very thankful to have this community, to have your support. So yeah, let's go GME. Let's see what these next couple of weeks bring. I'm very satisfied with what we saw this week. Excited to see what the future brings. So yeah, so cheers everybody. We'll see you next time. Thanks very much.